welcome to this week's Market Matters video update. Today it is the 22nd of October. We're back in the office, James. It's so good to see your face again in person.
There's not many people that say that, Harry, but thank you.
It's been 110 odd days since we've been able to catch up, but it's good to be back in the office and plenty to work through. Coming back in, plenty of work on the desk to get through today. But we're going to stop and talk about the emerging companies portfolio today. It's been a pretty solid performer of late. Had a pretty good run, but do you want to run us through that performance, James?
Yeah, so I thought I've had a few emails of late just talking about why don't we cover emerging companies more through Market Matters, and we that's not a new thing, and we tried to address that, I guess, a couple of years ago when we brought in the emerging companies portfolio. We charged you with the ability to be the portfolio manager, with me sitting over the top. So we've had, we're nearly going on 2 years of that portfolio. It's been a pretty good run. This financial year, the portfolio is up 15% financial year to date. So obviously, it's only we're only at the start of the financial year, but it's been a really encouraging performance in that portfolio, and it's been our best performing portfolio this financial year to date. The other ones have actually been performing really strongly as well, but that one's been a particular standout. So I just wanted to run through some of our high conviction positions in that portfolio today, Harry, and also some of the stocks that we're looking at. So we have, the universe is really big in that emerging companies space. So if you think about there's 2,000 companies on the ASX, you strip out the ASX top 100 in that portfolio, and we've got everything else. We stick to generally, upwards of a couple of $100 million market cap for liquidity purposes. But as a big universe, we need a lot of coverage on it. I'll kick off with you. Are there some positions in that portfolio that you want to talk about, that you want our listeners to know a little bit more about?
Well, you sort of touched on it there, that we're going to try and do something a little bit different with this portfolio. It's very company specific. You want to be picking obviously macro themes like we do in a lot of the portfolios, but there's a lot more, I think, company specific stuff in the emerging companies portfolio that we focus on. We've got a couple of positions at the moment that have done really well. Calix is one of them. It's been a standout. CXL is the ticker. They've got some technology that really reduces the carbon footprint of lime and cement industries. There's a bunch of other applications, but that's their main one at the moment that they're developing. They managed to sell a portion of that business off that valued that unit alone at $350 million. It brought in a really sort of important investor that's got some, he's got some feet on the ground around the world that can really implement that technology in a lot of spaces around that cement and lime.
I guess what you want to do, and this sets the scene for this portfolio, is we want to be buying companies with a lot of blue sky ahead of them. They might be early on in their journey, but they might need additional capital, bring in additional partners, etc. But the addressable market's huge, and that you touched on Calix, addressing that particular environmental concerns about the production of cement, etc. But it's got broader industrial applications. So that's it's a high risk. It's about an $800 million market cap. They're cutting edge technology. So it's going to be volatile, and it's not going to be for everyone. But that's a true example of an emerging company, an emerging technology that this portfolio likes to invest in. So that's number one. That was a good pick so far.
Definitely some blue sky in Calix. We're also going to talk about what are we going to talk about, James?
Nitro was one that I'd flagged for you. So if you think about as we operate globally and more remotely, I should say, globally and more remotely, signing documents electronically is really important. So DocuSign's the biggest one out there. It's capped it's in the US market. It's capped at 55 billion. Nitro is a lot smaller than that.
A lot smaller, but they do a lot more than just signing. Signing is just one part of their business. They've got PDF Pen, which is a PDF tool that you fill out your forms and things like that. So rather than not everyone's got a printer these days. Ink's pretty expensive. No one wants to chop down trees and print off that paper. So having these tools to be able to do that is pretty important. They've sort of switching from a one-off usage fee to a more subscription model. We're seeing that play out. They did really well the first quarter this year. to sort of build that revenue stream, and that sticky revenue stream is what's going to be important going forward, and how you value that company from there. Yeah.
So NTO is a ticker for that. That's a really interesting business we own in that portfolio. We expect good things. The growth is continuing to flow through for NTO. And the last one we're going to touch on was slightly different. So more of a valuation play in the space. Capital Health, CAJ. Tell us about that.
So that one's a diagnostic imaging company. If you want to go get an X-ray or radiology sort of play there. 80% of that business is in Victoria. Obviously, lockdowns haven't really helped CAJ of late. But you're looking at the Medicare data; it's not as bad as I think the market's fearing. They've only got net debt of about $10 million. Very small net debt. They've got plenty of flexibility to go out and pick off those smaller independent players. And then you line them up next to a Sonic or an IDX, and the valuations, 20 to 30% discount on a free cash flow, multiple, and that's huge when you look at listed players. That's a massive discrepancy there.
We think, if I'm thinking about one position in that portfolio that's likely to be active on the corporate side, so whether that's taking over other businesses or being acquired themselves, Capital Health fits that bill. So potential takeover target for the emerging companies portfolio there. We had one this year already in Ripe, which was taken over. And we've had a few in the growth portfolio that have been targeted as well.
It's been a busy year for the corporates out there, and we don't expect that one to really slow down.
You've only got to look at some of the stats that the investment banks are doing. Corporate activity is huge, and it's going to continue. And I think one of the things, just staying on that topic for a moment, one of the things is the outlook for interest rates. So when we think about and we write about bond yields ticking higher, that's serves as a kick up the bum for corporates to go and do something. You lock in cheaper long-term funding, etc. So I expect that corporate element to remain alive and well in the Australian market towards the back end of this year and then early in 2022 at the very least. There's a couple of stocks that we've got on our hit list in that portfolio. There's we have it on the Market Matters website. There's the hit list function that you can go and use, so you can go and create a watch list essentially, but we call it a hit list. So what are a couple of stocks that we're looking at, haven't bought, but we might buy for this portfolio?
Yeah, one that we haven't really discussed in Market Matters that's really interesting to us is GTK, Gentrack. They're software tool behind your utilities businesses, your waters, your energy, that sort of thing. Based out of New Zealand, bit of exposure in UK, Australia, and New Zealand. They're just cheap. You look at what they're trading on. Yep. They're not going to go out and shoot the lights out in terms of massive 20, 30, 50% revenue growth like a few of the other companies, but they can add an extra 30 million revenue with only 15 million costs, pretty simply. So they've a bit of turnover in terms of management, and we think that's actually a positive moving forward. It's put a bit of pressure on the stock, but looking at where that thing's trading, it's pretty cheap on a multiple.
Yeah, totally agree. So these guys do about 100 mil revenue now. They do EBITDA of about 10 million. But if you think about the change that's happening across the utility space, the energy space, water, and the data that we want to have as we move to, we're all more conscious about our environmental footprints, and that to make educated decisions around that, you need the data and you need cool interfaces. People want cool interfaces out there to do that. So Gentrack is really interesting. It's a $180 million market cap business that sort of fits. It's cheap, but we've got a big sort of growing catalyst, if you like, to drive the earnings of that business higher over time. So completely agree. Watch out for that in Market Matters reports.
Number two, definitely Shaver Shop is on the hit list. We spoke about retailers in general today. I'm probably due for a new one myself. Maybe you are too, Jimmy. Looking a bit stubbly there. Yep. Shaver Shop, we wrote about that a couple of weeks ago. It's bounced a little bit since then. Plenty of cash on the balance sheet. It's trading on a single-digit PE. It's paying a solid yield of I think 6.5%, 7% there. If you have a look at New South Wales reopening week last week, the amount of money that was being spent, I know a lot of it was in pubs and maybe not retailers, but the stats are saying that we were spending you're talking Boxing Day level spending throughout the week for New South Wales, and this is a nothing week in the middle of October here, and retailers are going to get that massive influx of people spending cash. Victoria's opening up today. You can sit down and have a beer in the bar. today in Victoria, so that's going to start hitting that state as well. ACT is going to follow, but as we head into Christmas, you've got Shaver Shop. It's got great cash balance. It's got solid earnings momentum. It's paying a good dividend. It's sort of hard not to like it, and very interested in that one.
What I think about in terms of stocks coming out of lockdowns or experiencing the conditions we've just experienced. So I want a company that has improved its business during lockdown so that it's got better earnings potential coming out of that. So if I think in a big picture standpoint, I think Qantas, and this is one of the reasons why we bought Qantas in the growth portfolio. They've made some tough decisions, but I think ultimately what we've just been through from lockdowns to grounding of fleets to all of that, they've readjusted their cost base. They're going to be a lot better business coming out the other side. They're going to print more cash. Shaver Shop's the same. So it's that true omni-channel, online and retail, online and in-store ability to purchase their products. Their online is growing. They've really up-spec'd their online, but they've still got the bricks and mortar retailing that they do pretty well as well. So that's one that I can understand your rationale around that.
Yeah, we do have a few e-commerce retailers, but how we shift that into having a look at Shaver Shops, something we're going to work on in the portfolio perhaps in the next couple of weeks. The last one we're going to touch on is Audinate. Had a pretty difficult week. They had a pretty strong quarter to start the year. The order book's growing, but they've got $14 million of orders that they cannot fill at the moment, and that's coming down to a chip shortage issue. You think of Audinate; these are chips that go into speakers and microphones and things like that, and they also do a video element as well, and it brings it all together. So if you're jumping on a train, and you want to link up all the speakers on the train to say the same thing at once, this is the sort of technology indeed in those speakers.
We've got it in the boardroom upstairs. We've decked out with Audinate. So it's a really cutting edge technology.
Definitely. And it's built a huge moat around its business. It's really hard to link up their speakers with another competitor's speakers, but they've cornered that market. They've got about 80% of that market at the moment. So you want to buy those products, those Dante products. You can buy them from a bunch of different suppliers, but at the end of the day, the chip in the middle is what counts and what will help you sort of sync up your audio and visual as well. We look at where that thing's heading. It's we're coming out of lockdown around the world. Stadiums are reopening. People are getting out more. They actually did all right through COVID. You actually had a lot of high net wealth people build home theatre systems. People wanted to stay indoors and use that, so they actually did all right through COVID and managed their way through it pretty well. But now they're finding this chip shortage, which is going to give them a bit of a backlog in terms of orders. We'll let this one sort of play out a little bit, but it has pulled back sort of $1.50, so it's starting to look pretty interesting.
Yeah, it's down. It's down a fair way. So we've had it on our radar for a while. It's always been a bit expensive for us. You want to go out there and in these sort of emerging companies portfolios, you want to be buying quality businesses that have taken a short-term hiccup. If you can get them at better prices, then that's great. They downplayed their their guidance for the next 12 months based on this chip shortage. The market frets over that in the short term. So after the pullback, it's well and truly on our radar. Harry, thanks very much for that update on the emerging companies portfolio. As I said, the portfolio's done pretty well financial year to date. It's up over 15%. Well done on that. The broader Market Matters portfolios have had a good start to the financial year as well. So plenty of time to go, but we're happy with how our positioning is playing out at the moment. Thanks for watching, and we'll be back next week for another update.